US equity are at a higher high. Is this the last hurrah? Well, let's go back to this chart of the US dollar index, which we looked at last month. So what we noticed here is that since the end of August, dollar has been coming down at the same time where the S&P was able to make a higher high above the January high. If we focus a little bit closer, then we notice that indeed also since the last week of August, US interest rates have been rising from 2.82 now to above 3%. And that has come up together with this orange line, which is the spread between US 10-year yield and German 10-year yield. That has also correlated so far with movement of the US dollar. So the recent decline corresponds to, again, the crossing of the cloud of the US dollar index. That means that US dollar index could go a little bit lower still. What has an implication on emerging market? Well, here we see it again. The same line since the beginning, the end of August or beginning of September. We notice that the emerging market have been trying to make a bottom on an absolute basis, and also here on the orange line on a relative basis versus the S&P 500. So this is good news. Not only emerging market, but also European market have tried to rebound from the bottom of the range a little bit higher, with also a rebound of the relative strength that we see here on the black dotted line. And despite the fact that it is still within a narrow range, we notice that these rebounds occur at the same time as the Japanese market, which is a little bit more dynamic and moving up, breaking above the upper Bollinger Bands, while of course the yen has been weakening a little bit. So now we are on the yen and the Japanese market at the same level that we were in the beginning of the year, namely in January. The momentum is relatively strong and it could extend a little bit more. Why then being eventually worried about what happened in the US market? Well, there were some signs of fatigue in the US market, and this sign of fatigue has been represented basically by the declining line, black line here, representing cyclical versus defensive stocks. So that means that defensive stocks, when it goes down, has been outperforming up to the point of the end of August. Now it's rebounding a little bit. At the same time, the green surface here represents the rising rates, and that has implication on different sectors. Recently, what we saw that the lagging sectors like materials have been able to finally break their range and try on the way up. Also, rising rates have helped financials move up to above their previous highs. On both, we notice also the black candles after the white candles, which probably means that there is some uncertainty about the breakout. Other sectors, like the leading sectors, like industrials, have also reached the former high of January, but also present this black cover, which is usually a sign that possibly you could develop a top or a pause after reaching the 80 levels or the January high in the industrial sector. We notice also the momentum is also toppy and could be turning down. But the main leaders have been the technology sector, and that's represented by the Nasdaq 100 index, the large cap stocks of the technology area, if you wish, as well as the semiconductors, which are the black line here, which are basically in a trading range and trying to test their bottoms or their supports, if you wish, which have been rising lows, but we still have also declining highs. So here we are in a more neutral situation, and the market is a little bit worried because we noticed that the volatility of the Nasdaq is not making really lower lows. It's trying to bottom and could prepare something bad. Indeed, just the last week of August, we had a top at 26.91, and since for the next 2 weeks, we haven't made a new high on the technology sector. So clearly the technology sector is underperforming, and the question is, will it lead the whole US equity market into a correction? Other signs of fatigue are found during the summer in the mid-cap and the small cap. Typically, we noticed here the relative strength of small cap and mid-cap coming down versus the S&P 500. So the breadth of the market is getting smaller. So only the large cap are doing well. How do they look like? Well, large cap usually are represented by the Dow Industrial, and the Dow Industrial in the last week has been able to make a higher high, like the transport, but immediately it is reversed in the last 2 days. So here there is again a question mark. Are we back in the range? Did we fail to make a new high? The answer is probably going to happen in the coming days. If there is effectively a correction, it could take the form of the green path that we have here, and if it breaks certain levels, namely the former lows that we had here around 28.64, it could develop into a full-fledged correction. It's possible in such a short time, up to mid-October, as it happened in January. It went very fast there. Maybe it will take 1 week more than the 2 weeks we saw in January, but it's not something that could be totally excluded. And this could happen despite the fact that emerging markets on a relative strength versus S&P 500 are bottoming. So clearly, in the coming days, we need to watch out 3 levels. Very short term, today, we need to see if the 29.15 level is going to be broken. Then, the day after, it's going to be 2900, which opened the way to the key level of 28.64 we just mentioned. And from there, we'll see if the correction develops all the way to 2800. Therefore, what you see in the emerging market, European market, Japanese market are good signs, but the signs of fatigue in the US market have to be monitored very carefully. We're looking forward to seeing you next month.